For a bit more on analysis on this, I want to bring in Raymond James, a chief economist, Scott Brown from St. Petersburg, Florida. Scott is a Bloomberg best for his accuracy on unemployment forecasting, and of course, former Treasury Secretary O'Neill, Paul O'Neill, still with us. And Scott, I'm looking through your numbers. You were predicting 120,000 headline, 135,000 private. So again, these numbers are well above those forecasts.
Well, it's stronger than what I was looking for. I really anticipated better job growth as we rolled into March, April, May. That's typically what you're going to see is that the firms do a lot of their new hiring in the spring. A lot of the strength that we're seeing in these February numbers is really a reflection of the poor weather in January. So I think you have to take January, February together. But again, I think more importantly, I mean, we're seeing a pretty good trend underlying here. Over the last year, we saw a very low level of job destruction. And what we've been missing is that new hiring, and that new hiring really seems like it's starting to get going now. That's a very good thing. Right,
that's what's been missing so far. John, give me some more about what's going on in the markets.
Well, so far, Betty, investors haven't seen a reason to sell. You mentioned that the Dow, S&P, and NASDAQ futures are higher. They were higher before this news, and it's coming after a rally in the stock market yesterday. Don't forget, though, in the most recent jobs reports that we've seen, it has not been uncommon to see moves that are very small on the day, relatively speaking, maybe 0.5% up, 0.5% down. Moving to the bond market right now, we are still seeing the yield on the 10-year higher, which means that there's been some selling in the bond market, which would make sense if investors are buying stocks.
Right.
Don't seem to be a lot of dollar enthusiasts this morning. You can see that, for example, with people buying the euro and selling the dollar. But again, very cautious trading in the currency market as well.
Okay. Mike, you've got some more numbers, right?
Well, we're looking at why the unemployment rate dropped. It fell to 8.9% because the labor force grew only a little bit and more people were hired. So it is a solid report in terms of getting hired. But the interesting thing is the labor force at this point is still smaller than it was in November. We're looking for why people aren't coming back to try to find jobs. If that starts to happen, you could see the unemployment rate tick up. But right now, as they say, the Obama administration is going to be very happy about this, Betty.
They are indeed, 8.9%. What do you make of that?
You know, I think it's good. It's not a surprise, I believe. The economy's been clawing its way back up the side of the mountain now for a better part of a year. And these numbers are consistent with that. You know, I must say I'm really kind of amused by how much attention we pay to these monthly numbers, and would make this observation. If presidents could really create employment, there would never be any unemployment. And so attributing to presidents or White Houses movement in our economy, I think, is an overstep.
Right. Yes, that is true. However, certainly, no government, right, can control the economy 100%. But I would say that the White House has tried the most, has tried to at least, with their stimulus plans and whatnot, to try to get the economy moving. I mean, have they done enough? They've got this job council going now.
Right. As you can tell, I think it's fine. It's probably at least a positive, but I honestly don't think it makes very much difference. You know, employment comes from individual decisions all over the nation by people who have an ability to hire people, deciding that there's enough demand for them to be able to cover the cost of additional employees.
Right.
And the government can do all the chest thumping it wants to. At the end of the day, it's all those factors all over the country.
Okay.
And I think where we are is a process of natural healing of our economy.
Scott, what's going to make the difference?
Well, I think now that we've got the employment numbers out of the way, people are going to start looking more towards the future. And we're seeing some positive trends here, but there are two negatives. One is the weakness that we're seeing in state and local governments. That's a bit of a drag on growth. Obviously not enough to get us anywhere close to a recession, but it's going to keep the pace of recovery a bit weaker than we'd like to see. We'd really like to see much stronger growth. GDP numbers on the order of 5 or 6%.
Right.
That doesn't seem likely. The other issue is gasoline prices. So now we can focus back on oil prices, and that in turn is going to have some dampening effect on consumer spending, and it may reduce hiring plans a little bit as we go forward. The big question is with oil prices is how high do they go, and how long do they stay high? And if this recent spurt that we've seen in late February, early March, if that sticks, that's going to shave maybe 0.5% off of GDP growth. If it goes higher, that's going to be even more of a negative.
Okay, right. That is a big asterisk when it comes to looking at the economy and the job market. Scott, thank you very much.